Hello, welcome to this carrier update brought to you by Powerfleet. I'm here with the Sultan of Sonar, Zach Strickland. Zach, what are we starting it off with?
So we've got our chart of the outbound tender volume index in orange and the outbound tender rejection index in blue. The big takeaway of today from this chart is this big drop right here, 1776. Not just the year that we were founded. It is the percentage of rejected tenders, and we've dropped below that 18% threshold, and it's a sharp drop. 42 basis points down from yesterday. This looks like a pretty big deal to me. This could be the start of something that's relatively important. If we start to see capacity ease significantly, we'll go into that a little bit later, where in the country we're seeing this, what's driving a lot of this. But still, I'm cautious to think that we're hitting some sort of inflection because demand is still relatively high. I'm not seeing a dip in the OTVI. You see this small drop here, but keep in mind that rejected tenders are in the OTVI too, so that's also playing a role in moving this down a little bit, and it's simply not dropping as quickly as this one down here. So this to me isn't necessarily a demand side decline. It is more of a carrier acceptance situation where they're able to cover more freight in the United States currently. So as long as this thing remains elevated and we're not seeing a sharp fall here, there's always the question of how strong is this downward pressure on the tender rejection index, because we're just not in that point where I think we have enough capacity to cover everything. 17.76%, though, seems very low in the context of the last year or so, or 18 months. It's still historically high. This is normally a peak season value that we're talking about. So I'm curious to think, we're ending the third quarter. Normally March has a little bit of a bump in it. We've got sales quotas. Regardless, that sense of urgency starts to pick up mid to late March as people kind of push things out the door. And of course, we've got Easter holidays and things in April. So I don't know if I'm going to put too much stock in this. April, I would definitely expect this type of move. March, I don't know.
Yeah, it definitely seems like this might be, like you said, a shift of something new, but maybe too early to tell. Especially interesting to see how the volumes still maintain this high level.
Yeah, it's not a demand side drop. So let's look at our next chart here. Looking at the average spot rates in the United States, because that's what a lot of people are interested in. What does it mean for my rate situation? So tender rejection rates in the near term, when they drop, they do kind of ease that pressure on the spot market in general. The long-term underlying movement of the rates, however, is driven by the length of time those rejection rates have been up, as well as the other cost inflationary pressures such as fuel, which you'll see right here. This right here is, even though that rejection rate is falling, this right here is what people need to be paying attention to. This is disgusting in terms of inflationary pressure. From I'd say about this point to early year, from here to here. So there's a pretty big rise in fuel and the average price of fuel, retail price of fuel in DOE. That accounts for roughly an 8 to 10 cent per mile inflation in the underlying spot rates. Now, what you can't see, because these rates didn't go up during that period of time, it's because it's so fluffed up with market volatility and profit margin, et cetera. So you can't see the underlying inflationary pressure in some of these rates because they're super high. What it's going to do, though, is at some of these low ends, which I'll show you in just a minute, is going to start increasing that floor of the rate. So you're thinking, okay, so as tender rejection rates come down, et cetera, we get all the way back down, these rates are going to go all the way back to where they were. No, they will not. There is an underlying cost factor, inflation on labor and wages and various other maintenance, all those trucks that are now a lot more expensive than they were 2 years ago, all play a factor in keeping these rates elevated over time, and we'll see that play out. Now, over the last week though, van, you can kind of see this little slight slant downward. Reefer still has a lot of fluff in it, obviously, a long way to go, but they're all dropping. Flatbed, like we talked about, still coming up. Let's look at the next chart real quick to kind of illustrate what I'm talking about. Average spot rate, truck stops, top 100 lanes here. The reds indicate that downward week over week movement. The greens indicate the upward week over week movement. Down here in the bottom right, these are the lowest priced lanes, and they're almost all in green. Why do you think that is, Anthony?
Why is it, Zach?
Because you've got some fuel prices are actually making an impact to those because they are close to that cost threshold. So this is more of an inflationary sector, whereas those, they still have all that market bidding that's keeping those margins high enough.
Yeah, I mean, this map is looking like almost like Christmas themed over here with like the little sparkles of green. Zach, thank you so much for this insightful update, because those downward movements on those rejection index with those volumes is staggering right now, especially with the price of fuel. So Zach, thank you so much for this update. We'll check in with you again throughout the morning. Right now, we're going to toss it over to Kaylee Nix.